Mute myself. Okay. Welcome to Leicester Real Estate Investment Program. Um, this is our new platform we are broadcasting from today, and we're so glad to have all of you taking time to watch our program. Today is our first time on this new platform, and we have our special guest today who will be telling us about the mortgage industry. He's been in the mortgage industry for a long time. As I told you all, we'll be inviting guests on this new platform. So today we have a guest, and he is none other than Mr. Elliot Roberts. And I'd like to just welcome Mr. Roberts now to the platform to be a part of our program. So welcome, Mr. Roberts.
Hi, how are you today?
I'm good. I'm good. So can you tell the
Good.
audience who is Elliot Roberts?
So thanks for asking, Lester. And first and foremost, thank you for having me on your show. I'm really excited and honored to be one of your first guests on your show. So thank you. A little bit about myself. I'm with Embrace Home Loans, and I've had the opportunity to wear several different hats in the industry, which is from underwriting to processing, working at Fannie and Freddie, and had worked at some big lenders here in the Washington metropolitan area. So I would say a total of 23 something years. And I'm just super excited to be here and talk with you a little bit more about the mortgage industry.
Oh, so thank you very much, Elliot. And I'm so glad to have you. Thank you. I know you're a very busy man, and I'm so happy that you can take out time for your busy schedule to be a part of our program, at least to educate the audience, because this is an educational program, and we try to educate people about what's happening in the real estate industry. All right. So, can you just give a just brief summary of the state of the mortgage industry right now?
So the state of the mortgage industry, you probably see on the news, banks falling and things like that, higher interest rates, Feds raising the rates, low inventory. So you're seeing things and you're hearing commentary about the industry. But what we're not hearing is that people are still buying. What we're not hearing that there are people out there that are looking to purchase homes. Construction costs are starting to slow down. There's going to be more new builds coming in the market. There's indications that mortgage rates are going to come down eventually once we get through the economical, uh, time period that we're in, based off of either the war, inflation, whatever it may be. It's still a great time to buy. There are plenty of mortgage programs out or products out there for either first-time home buying programs or people that are looking to maybe tap into their equity, so they can either do cash out refinances or open up a HELOC maybe and do some home improvements, raise your value, maybe even look in purchasing a second home, or an investment property. So the market is still hot. We just need to capitalize and being able to help those people and put them in the right programs.
Good, good. And you just brought into our next question was what are the different type of loans or things that people can get into? I've read that you guys educate them about what are the loans out there that they can possibly benefit from.
Yeah, so really, and when I talk about first time home buying programs, these programs are tailored towards buyers that have one of the three things missing in their portfolio, let's just say in mortgage financing. We look at the credit profile. How good is their credit, or how bad is their credit, or what can we do to help raise their credit scores? How much money do they have to put down? And where's that debt to income ratio are the three main parts when you're purchasing a home. And sometimes a first time home buyer may have good credit, maybe credit above that 680, 700, 720 credit score. Maybe their debt to income ratio is low enough below 50%, and they have plenty of money to put down at least 3% for a home ready or home possible mortgage program. Ultimately, a buyer's goal is to get them into the lowest payment to them. And sometimes it's in rate, sometimes it's in eliminating mortgage insurance,
Mhm.
sometimes it's the type of home that they buy. There's many different factors that go into a mortgage application. And a mortgage loan officer's job is what are their buyers' pain points? Where are they in the most need? Is it the assets where they may want to use the Virginia housing program here in Virginia, where it's 1% out of their own pocket, and VA comes out with the 2% needed for the 3% total of a purchase of a VHDA is what it used to be called, but Virginia housing, or 100% financing for our veterans, or 5% down on a regular conventional conforming loan. So it's really a lender's job to look at the full picture of a borrower and discuss with them their short-term and long-term financial goals. So we can best help them and put them in the best product.
Good. Thank you very much for that information. I appreciate it highly. So at least they know that they are very different based on their own situation. That's where how they get placed, right? Beautiful.
Based on their particular situation, then we are able to figure out what's their best mortgage product based off of their needs. Exactly.
Good. Yeah. All right. Good. So can you just give us what is the current interest rate today?
So that's when I get that question, I'm asking, I have a whole bunch of questions that go on in my mind. Well, what's the interest rate? Well, there's a lot of things that come with that, right? Are you buying a condo? How much money are you putting down? Where's your credit profile? These three things affect a borrower's interest rate, because think of mortgage lending risk base. So let's think about that. If your credit scores are high and you're putting more money down, you're a lower risk to a lender because you've shown proof that you can make your payments on time with high credit scores. You have the money to put down. You have skin in the game. So a lender feels like, okay, we know that this mortgage payment is going to get paid. So this particular borrower in this example is going to have a lower interest rate than someone that may have lower credit scores. Maybe the life struggles and happenings prevented them to really have their scores higher. Or maybe they only have that 5% to put down. So in this case, with a borrower that has a lower credit score and not much money to put down, is a little bit more of a risk to a lender. So a lender's rates are going to be slightly higher or higher than the previous example with someone that has higher credit scores and more money to put down. To answer your question though, Lester, the national average right now has been floating around that 6.99%. I've quoted a high balance loan that has about $800,000 today, right at that 5.99% using the loan level price adjustments through Fannie and Freddie. And it all depends on first-time home buying program. It depends on the area median income limit in the property that they're looking to buy. All these things matter. That depends on where that interest rate lies for a particular borrower.
Okay, good.
A lot of information, Lester.
I know. I know. Just crunch it all into one. But at least thank you for that. So if somebody want to buy a home, they want to know the difference between a hard credit pull check and a soft credit check. What's the difference? I mean, how is the credit affected with a hard credit or soft credit?
That's a good question. A lender should always pull hard credit because the auditors, when a loan is sold on the secondary market, they're always going to ask for a hard credit report pull, which is the three repositories: Experian, TransUnion, and Equifax, all on one credit report. A hard credit pull shows all of their liabilities and gives three credit scores, where lenders use the middle of those three scores. Well, if a lender's doing a soft credit pull, are you going to have all the information needed in order to best help that borrower? No. And so now you're going to do a hard credit report pull at the time of ratification, where their scores can be reflected differently. Now the interest rate that you were quoting them could be a little bit different. or maybe something comes up on the credit report that bumps them out of qualification. Credit report pulls are necessary. Hard credit report pulls are important. And borrowers can shop for mortgages without their credit scores being negatively impacted within 30 days of each other. So if the first lender pulls a credit report on April 1, anything between April 1 and April 30th, that 30-day window, a borrower's credit score will not be negatively impacted. That's due to the Dodd-Frank rules that came out in 2016.
Okay, good.
Allowing borrowers to shop for mortgages without their credit profile being negatively impacted.
Good information. So, okay, what does someone need to do to get qualified for a mortgage?
Well, first, they should start looking at lenders that are going to fit their needs. Every borrower has their wants and their needs, and being comfortable with your team, because I really believe a borrower is building their team in the real estate process of buying a home. One of the most important people on that team for a borrower is you, Lester Witherspoon with Sampson Properties, because they need a good real estate agent to take care of them. So that is their first person they need on their team. The next important person is the loan officer. And finding the loan officer that works with a reputable company that's going to provide them the information, the data, so they can make the best decision for themselves is important. And having a hard credit report pull, having a lender review their personal documents, which are their pay stubs, W-2s or 1099s, reviewing the debt to income ratio, submitting it through AUS, automated underwriting, doing all the hard work up front so a borrower knows where their comfortable monthly payment is because it's been discussed. Comfortable out-of-pocket costs because it's been discussed. They did the hard work up front. Now they can have fun with Lester Witherspoon with Sampson Properties because they've already got their pre-approval done, set, worked hard, had the lender review their documents, already discussed the max purchase price and or comfortable purchase price. And then they talk with you about location, type of property that falls in their comfortable zone. So really getting the financing up front is important so you can set those proper expectations for a buyer. So all parties are on the same page and you're setting up your borrower for success.
Good. Yeah, thank you very much.
That's a lot of information, I know, Lester.
Oh yeah, I know, yeah. But at least they got an idea, of what to expect and what the process look like. And then we want to ask, what are some of the things that a buyer should expect to pay during a transaction, during a home buying process? What are those items to look forward to paying during that process?
So that's a good question, and I'll hit the tennis ball back in your court because one of the first things that a borrower needs to pay for is on your side of the transaction. Within that first, after the ratification, what is that one piece of information that they need to obtain in order to feel confident in buying that house? Is there a cost there? What is that?
Say that again.
So isn't there a cost for that home inspection?
Well, yeah, definitely, yeah.
So the cost of the home inspection.
And they will pay it based on the square footage of the home. Yeah.
So that's the home inspection cost. Okay. Okay, perfect. The only out-of-pocket cost that is asked by a lender after the disclosures have been signed, because it's called the intent to proceed document, is in that disclosure package. By law, that's when a lender can ask for monies. And the only monies that a lender is going to ask for up front is to pay the appraiser to go and appraise the property.
Okay.
Which, depending on the size of the home, if it's a high balance loan or a jumbo loan, it could be between $570, maybe $700. It just depends. And then at closing, on the closing disclosure, it'll say POC, which is paid out.
What happened to Elliot? Oh wow, something went wrong. Okay, I see you back. Okay, you back. I said, what happened to you? Okay, you're to POC. What is POC? No, I can hear you. Can hear you. Yeah, I can hear you. No. Nope. Nope. No. I don't know what happened to the audio. It's gone. Oh, we lost him. But I think this was good information that we're sharing here today. This is our first program, and we have our first guest. He's a mortgage lender, Mr. Elliot Robert for Embrace Home Loan, and we invited him just to give an idea as to what is happening in the mortgage industry, so people can know exactly what they need to do, how to go about it, what to expect. At least so, and I think he really hit some good points, letting you know that even though we say the interest rate is 6% or 7%, but it still depends on you. It depends on where you stand. Do you have enough money saved? Do you have good payment history? So all these things they were taking into play to really find out where you really stand actually, and that's what he was trying to explain. You know, and I mean, sorry that he had cut off. I mean, he just got off. I don't know what happened on his end. He got off of the program, but I mean, it was very, very good information. I really hope you all learned something from this program, or maybe we invite him again another time. Or depends, we don't know. But I think he really gave some good information. And the bottom line is that it all depends on your own situation. It depends on your own situation. So you need to do your homework very well. You need to make sure that if you want to buy, you start planning for it. You can just jump out today and tomorrow unless you buy in cash. Then it's a different ball game. You got to go to the lender, all that. But if you want to get a loan, you have to plan for it. You have to plan for it. You see? And that I think that way you're trying to drive home, and that we're trying to go to end the program, but then he dropped a lot. I think he had some technical difficulties. Even when we started the program, we had some because we couldn't hear him, couldn't see him at first. Then finally we could see him, couldn't hear him, so it took some time. That's why we're late starting the program today. Normally we start 6 p.m. to start airing, but still we finally my technical man, I salute him for at least for the job he did well done to make sure that this program go live today. He was all making sure that it go live today. So the bottom line is that you got to make sure of where you stand. You got to make sure of where you stand. Do your homework well. Make sure you pay all your debt, or make sure that you reduce your debt as much as possible. Make sure that you have saved enough money, and make sure that you have a good credit score. If your credit score is good, it puts you in a better position. If you have enough money saved, you get a better interest rate. You get a better interest rate. So why it is true, it says 6 point something, almost 7, but you can still get a lower rate based on your own personal situation. So you have a part to play in this process. You have to do your homework, you got to plan for it, and you got to make sure that you are ready to buy in order to make sure you get a good deal going for yourself. So glad to have you on the program today. This is our first program on this new platform. It's a new platform we start broadcasting on as of today. And today our guest was Mr. Elliot Robert from Embrace Home Loan. We'd like to thank him ever so much for taking time off his very busy schedule to just jump on and give a few words, a few tips, at least as to the state of the mortgage industry and how to go about preparing to purchase the property, some of the things you need to do, some things you need to expect. You know, he talked about all that. So we'd like to thank him very, very much. Just sorry that he got off the program, he couldn't end. But again, we're happy that he took time off to come on, at least to educate our audience as to what's going on in the mortgage industry. And so feel free, call me or text me if you have any question. My cell phone number is 302-310-0621. Again, my cell phone number is 302-310-0621. This is your realtor and investor, Lester Witherspoon, saying thanks once again. Glad to have you. It's always glad to have you. So we look forward to seeing you again. Every week we'll be on, and we have other guests coming on. We have other, as you were naming the other participants that make up the team. We have members from each of those different sectors to come at least tell their own side, what they do, the home inspector, the appraiser. All of them will come and invite them, asking them, the lenders and all that, the title company and all that. We try to invite them so they can come give a more detailed information as to what do they do in the home buying process. So, but for now, we say thanks for taking time again, and we hope you have a wonderful rest of the day and enjoy the rest of the week. If you have kids, I know this is the spring break. I hope they are enjoying it, and we look forward to seeing you again, and we'll definitely keep in touch. But for now, we say bye. Take care. Enjoy yourself.